All right, what's up, everybody? Trying something new here. New format. Just gonna do afternoon streams instead of Zoom calls. Hello, hello. What's up? What's up? Got me some lunch really quick. Going into the new marketplace launch. Our whole brand, our whole everything is taking a whole different direction. Also be doing live trading. But the shows, we're gonna have content kind of going around the clock. Morning shows, afternoon shows, live trading sessions both times. I know technically I don't trade after 2 p.m. Eastern, but even if there's opportunities to make plays, or even talking about the market, we're gonna do that as well. But we might as well just sit tight and hang out in the afternoon and test a few things out. Just to recap, the market's traded higher. Off the open, close to about 25 points in the S&P. I'm just going to draw DD bands real quick. If you go into the overnight dynamic, like my trade's shown on the screen down at the bottom. I'm going to start organizing my trade of 8 on the screen again. So this is probably the best way to do it. I can get everything shown on there. DD bands. If you go to the bot channel here, these are important. They're posted here. 5272, 5337. 5272, 5337. The S&P traded from, we talk about these all the time. This is one of our lessons we teach. Is that when this DD ratio is greater than half, you'll notice that there's about a 75% chance you hold at the bottom of a bull zone. Bull zone is here. That's a really solid play. If you look at the cheat sheets in the chat room, I'll teach you guys how to do a couple of things. If you go to the RS Discord right here, up in the training, there's something called cheat sheets. But I have all these little graphical sheets for you to be able to utilize to understand how each of the tools works and what they exploit. D ratio is here. Very plain and simple. Anytime this ratio is greater than half in a rational market, you expect bull zone support 75% of the time under all conditions. And it's a little bit higher when it's rational, but 75% in the worst case scenario is irrational. So it's a very high probability bounce off a bull zone bottom. Rational is closer to the 80th percentile, and it's basically played out today exactly like that. So it's nothing too hard to see about this one. Bull zone bottom is shown right here. Make this a little bit bigger. You see? Liquidity map shows bull zone bottom. I bounce right on. It's super pretty, right? Super easy. Most of my trade was taken on the long side tonight or last night. This morning, I took a short setup from here to here on the break. Got out. Once that resilience number was negative, I also tried to short a second time and took a loss, cut it, and then send the profit. So I don't want to get rid of too much of what I started with. And for people getting here, and I'll go over today's lesson. Every morning, there's a couple things we do. Everybody, if you go here really quick to the Discord, make sure you have your cheat sheets open because I'm going to go through each one of them, and then we'll go through the lesson. First thing we do every day is we look for, at the start of the day, see what the greater market condition is. The greater market's one of the easiest things to figure out. You're looking at three different things. You're looking for monthly map. You're looking for monthly hedge pressure on SPY. If you're trading futures, NASDAQ, S&P, it doesn't matter. You need to understand this part right here. And DD ratio. Okay. What these three things do is the monthly map is the distribution of risk, the landscape of it, of dealer options for the S&P or NASDAQ or whatever I'm looking for. Monthly map in SPY is the landscape of SPY, its own options. Monthly hedge pressure in SPY is the hedging against its own monthly options. Creates a very large shift. We call it bull structure and bear structure. And then the DD ratio has to do with the strength of the stocks inside the S&P itself. So for the greater bull market, we call this greater market. It's very simple. Whatever the greater market is, those are the setups I'm looking for. If the greater market is bearish, I take bear setups. Greater market is bullish, take bull setups. First thing you do for monthly map, you click this button, you load up any chart, you open the top left, you click this button, it says monthly map. If you have the liquidity map indicator that you bought from the marketplace, this is going to be here. Comes with the monthly map in it. And what it does, it's going to show you what SPY looks like over the course of time, over the future. This actually stretches all the way until September. It's showing you how options risk is distributed between now and September. To read the monthly map, there's a cheat sheet in the Discord or on the website. I'll load it up really quick. Looks just like this. It's very easy how to read this. I'll make it a little smaller. It gives you a general informational piece right here. And if the market is bullish, if price is in a bull zone over time, it's a bull market. Price in a bear zone, it's a bear market. As you see, this green line on the charts is stretching all the way across the dark gray, which is bull territory. It's bull market, right? So in general, it's a bull market. And how's the bull market looking over time is you have to look at the bottom of this bull zone, like right here. And basically, I'm just kind of drawing a line like this. You see that over time between now and the future, this bull zone is sloping down. It has a couple of speed bumps in it, but the bottom is sloping down. It tells you the bottom is sloping down just like this. Longs are accumulating, and therefore longs are becoming longer. People that have bought calls are likely to exercise them, forcing the call sellers to long the market, which is going to press the market up higher. If price exists in a bull zone over time and the bull zone is getting deeper and deeper below the price, then longs are accumulating over time. So we could say the bulls, longs are bulls. The bulls are becoming more bullish. Okay. The next step is the bear side. As you see, the bear side right here is also sloping down over time generically. From the current price, bear side is sloping down. The bear side is sloping down. Bears are exiting positions. So bears that are short are also covering. It's not only longs accumulating, but bears are getting squeezed at the same time. When both sides are sloping down, this is a very strong bull market over time. So this is over the course of time. And you can actually look at the axis at the bottom. It's telling you this market is bullish. I mean, such a great tool all the way through the end of July. The June and July is going to be one of the strongest bull markets we've seen unless something changes. Very strong. Through July. You'll see how that works. Yeah. Monthly hedge pressure on SPY, very easy to see that. Just click daily mode again. 525 is where it is. We're trading way above 525. So on structure, full structure on SPY. That's it. So monthly hedging over the course of the month, it's going to gain a little bit of positive pressure just on the monthly options as well. DD ratio is, so these are based on SPY's own options, which are betting on the SPX value. DD ratio is talking about what the stocks inside the index itself are doing. And if that number is greater than half, stocks are bullish. So the index that's tethered to the stocks not only is trading up on its own options and its own hedging, but it's also going to follow stocks that are also bullish. So the greater market is bull, bull, bull across the board and bullish through July. Easy as that. You may have any questions so far? You can use the platform to get this information. Every morning I do this. If all signs are up, then I mostly look for long plays unless there's a short setup, and I'll take it in a very short-lived play if I ever do. I need really good evidence to short against the bull market. The next thing I do is I analyze liquidity map. Indicator right here will show me what I'm expecting. If the open price is support, it goes to resistance. That's from here to resistance. If the open price dips, the blue is that next support. You know, we look for, which is 1B. And anytime this ratio is greater than half, we always long at the bull zone bottom every time, or sell puts down here. It's like that. Great easy setup. Nothing was too hard about this one. I use resilience as an indication of the strength of the index itself filling its gap based on what the stocks are doing. And this morning, resilience was looking pretty nasty until about here when it started to heal itself. So while I did take a short inside of here and get a profit on this, because resilience tells me that we're going to fill the gap this way. Now, even though it's a greater bull market, the market can dip really heavily before rallying, which is what it usually does when this res number is negative. This white number shows that the market's going to push from that side of the box to here. This is the open and close price of SPY between yesterday and today. And that's negative. I'm looking for that short pressure. When we came right up here to the half gap, I took a short and got squeezed and stopped out and took a little bit of a loss. Wasn't really that bad. But once the resilience number goes back to being positive, then about right here, I'm back to the good side of the trade. And then if I were trading, which I wasn't, had a bunch of meetings today, I would have longed from here. So at the start of the day, when we're only looking at the long setups, the long setup was to long here, long again here, and bet that it stays above blue with the stop down here. Pretty simple, easy setup. And that's how you do it. So the greater bull market's telling me, am I looking for the long or short side of the trade? The short side setup this morning was blue as resistance to bull zone, knowing that you have a 75% chance that it stays and a 25% chance that it breaks. My trades are there actually in NASDAQ. So similar to the S&P. As that resilience number was negative, I got in the NASDAQ short, and then that happened, and I got squeezed. Immediately when this happened, I got squeezed. And then as soon as this number goes positive right here, it's no longer short territory. It's just, taking the long from there and keep going. And most of our traders understand that, and nobody shorts and bag holds against that, right? Get caught in the cues, but long the back test, hold of hedge pressure. Nice. That's basically what everybody that got knocked out of the short side probably jumped to the long side at that point. Very strong support at 25. Oh, yeah. Can I eat my pizza real quick? Oh, yeah, this market's going to close long and strong today. We also have a 56.35, a liquidity pivot up at the top. It's the target. If not hit by now, before the session ends, can definitely go for it by the end of the day. You guys have any questions for me? Like, usually I start using these afternoon. We don't really ever do this time slot, so we're going to try to grow it. We'll be consistent here. Try to be here every day at this time. Questions you have, or any tips or tricks about the platform, any use issues of the platform that you want me to cover, show you how to use stuff, how to do stuff, anything, feel free to holler at me. Any stocks I want to look at? General thoughts on trader funding accounts? Useful, better to trade on an account, sign up for elite trader, but still navigate for making moves. Yeah. We have a code there, by the way, for Elite Trader. If you want to do it, sign up all your accounts through us if you want. Let me give you the link really quick. We get a discount from them. Oh, use the code? Okay, cool. Yeah. So we have an ETF account. Yeah, they're good. Like Elite Trader Funding is really good. Pretty straightforward. I think trader funding programs are fantastic for people that are newer to the game, or even people that have been around for a while, are trying to practice or get better at trading. It's a definite good solution for many people. Easy down a little bit. Yo, what up, Justin? What up, baby? Did you trade today? Trader funding programs are like what I like to call intermediate risk trading. Example, the three different places you could practice pretty much: paper trading and live trading. And right, for the longest time you had one of the two, and that's all you could really do. Paper trading is zero risk and absolutely zero return. And what do you get out of that? Basically, you just learn how to push buttons, okay? You don't learn feelings. Like, the hardest part of trading is feelings, guys. Like, when you start doing this full time, trading, feelings like it. That's the hardest part. Feeling a certain way, feeling FOMO, feeling scared, feeling nervous, feeling anxious. These are the things you battle when really betting your money and gambling and stuff, right? So that's kind of what the important part is you don't really learn much in paper trading other than you learn how to push buttons. Okay, buy something, sell something. Okay. What live is you know, full risk, infinite return, right? The spectrum of live is from 0 to infinity, and you learn everything you need to know, but at the cost of full risk. Zero risk, you won't learn anything. Full risk, you learn everything, but your tuition can be very expensive, right? For the longest time, that's all you had. You know, you would paper trade until you felt confident enough. You jump in, get your feet wet, and typically feelings would kick your ass. And there was really nothing you could do but one or the other. And for the longest time, until last maybe 3 or 4 years, until the popularity started to blow up, there was no middle ground until now. Trader funding programs are all over the place. So I'm going to put it like, draw it right here in the middle, is trader funding programs, okay? There is some risk. You're paying something, usually a fee, right? Then you have the eval. There's some risk, there's a fee, and there's some return. You actually get paid to trade. And it's interesting how this works. So you actually had this like intermediate realm where you can, and so what do you learn? You also learn everything, almost everything. Except how to lose your own money. And that's a skill set in of its own. You learn everything in trader funding programs, just like you do here, but with minimal risk, because you're only losing the fee that you paid. But the fact that there's some risk and some return, you tend to take it a lot more seriously than this. With no risk and no return and no feelings, you're not learning anything. But down here, if you start blowing up a paper account, you're not going to deal or do anything. You're going to just do dumb things like just, okay, let me do this or do that. But if you start saying, oh, okay, well, I bought this account and it was only cost me $20 a month, but if I win, I'm going to get a profit. So let me take it a little more seriously. And you're going to start trading it because you're trying to make it work. So you're actually learning the art form of trading because there's some risk and some return. Now, the best part is that your risk is just the monthly fee you pay, and your return is after you pass a couple of evals and then pass the timeline and all that, and you get paid. You're balancing a lot of feelings, if not more feelings you normally would. You're having to pass a harder test to get paid here in a system that's, for the most part, designed to capitalize on the maximum amount of failure with enough passing to keep everyone interested in playing the game. Like a casino. There's nothing wrong with the casino. There's nothing wrong with the trader funding program. Casino is designed so that every once in a while someone wins big so that everyone keeps playing. But the house has the advantage. And it's okay. I mean, it is a thing that we allow in our society. The trader funding programs, in return, not just a casino, because they're offering you education to go with what you pay. So in reality, it is the cheapest, and my summary is that it is the cheapest real education, period. Trader funding program is the cheapest education you can have in trading the market. It's no cheaper than that. You're renting a fake trading account that may pay you out if you did okay. And they're teaching you very strict rules to trade in, where normally you have like infinite spectrum of what you can and can't do. Trader funding program forces you to pay attention to stuff like drawdowns, daily loss limits, and things like that. So you asked my opinion, Tom, on trader funding programs. Does that make sense? Because there's some risk and some return. You're taking it seriously and you're developing your skills and the feelings around, because you don't want to lose that account. A paper account, you have no attachment to it. But anytime you pay like something to something, like $1 even, you feel an attachment that has value to you. And so you get a very cheap education. You don't lose any money if you blow up. You just paid your monthly fee. If you make something, you have a very decent possible return. Right? Biggest trouble is giving profits back. Needed better with closing down the computer once a trade is made. One of the best things that can help you with that is to find the greater market in the morning. Greater bull market, greater bear market, doesn't matter. And then find the best bull setup you can, whether it's in an index or in a stock. And then trade like, if it's a stock, trade like 3 or 4 different stocks. One trade a day. Some of them may work, some of them may not, but over time, you should be doing better. If it's a bull setup, taking the bull side. If it's a bear setup, taking the bear side. Diversifying and doing that. Is the index, the NASDAQ, the S&P, Russell, and Dow will pretty much almost always trade the same direction. You just pick one. And if I trade one trade a day like I normally do, I'm going to start trading more often just to showcase more skill set in the middle of the day, just because my one trade a day is very slow paced for a YouTube audience. So I'm going to try speeding it up a little bit, doing a few more trades. Biggest struggle is closing down the computer once one trade is made. Make one trade, or if you're like committed to 2, after your second one, get out. But basically commit yourself to a maximum amount of trades. Enter the thing, close it down, that counts as 1. If you find a second one, get in, get out, that's as 2. If you're trading more than 2 times a day, or you have positions open more than twice a day, you're pretty much going to fall victim to the law of large numbers, which basically states that like over a numerous amount of iterations, you start to lose any edge you had and revert back to the mean, which is that the house has an advantage. The more you do, eventually you lose. That's kind of basically how that works. So like an example with the law of large numbers is if I were to challenge rest in peace Kobe to a one-on-one, right? Like first person to 1 basket wins and I get the ball first. Okay. I might get lucky and win. And if I never play him again, then I can say I beat him and never had to play again. If I played him 100 times, if I won 1 time, I will lose the other 99 every single time. They're large, and the mean of those trials will be that I will have lost to him over time. So the more you do, the more you realize the house has an advantage and you lose. The more you trade, ultimately you lose. That's everybody's problem. I don't care how good your strategy is. The more you trade, you ultimately fall victim to the house advantage, which is all the advantages of information that you don't have. So you have to find an edge and exploit it a couple of times a day, and that's it. Get out of it. That's really the trick. So I make a couple of trades in the first 2 hours and I usually call it. I feel like my edge diminishes the less I know about the market, and further time passes, I walk away. So make one trade a day, maybe two. There's a very solid edge, and the easiest trade you can do with the rocket scooter stuff, liquidity map, is bull zone bottom. Everybody here in bear zone top. Everybody here will never trade against that. Not once. It is the highest probability trade that we have in our system. Bull zone bottom, DD greater than half is always a long signal. Bear zone top with DD less than half is always a short signal. The probability of that based on humble traders back test to date says that under all conditions, which means rational or irrational, 75% chance you stay on the side you opened at start of the day. 1 out of 4 times it breaks, 3 out of 4 times it holds. This is mathematically, statistically an edge in the favor of us. And when we talk about edges, remember, the more you play the market, the less more you water down edge and the less effective it is. So Tom, like, if I tell people like they're trying to worry about like patience and trading once or twice a day, bull zone bottom, bear zone top is the gimme trade that almost everyone here takes every single time. It is so, it's not just 52-48, it's literally 75-25. It's such a strong pivot. Without a catalyst, without an event, it will hold 75% of the time, statistically, right? And again, there's no guarantee your trade will work, but that's a statistical backtest number. And so if you stuck to one trade, one entry to practice and get good at, you need a bread and butter as a foundation to grow your account while you experiment and play with other kinds of trades. That is the one thing to wait for. If you wait and wait and wait and wait and strike, and you strike with a moderate size where you don't lose more than 5% of your account, or what, 10% of your account at the most, or something with a big heavy trade, you know, enough iterations, the law of large numbers will draw it towards the edge of a 75% chance, right? So you find the edge that you like and stick with it as a rule of thumb. Jay Sasha, what's up? Hey, goes, can you go over the MHP scanner setting you talked about? Oh, the atom bomb. Okay. The atom bomb is great. So what we're going to do, I'm going to clear out all the scanner settings. The bottom of the screen, you click on scanner and then you click add. We all know that every time hedge pressure breaks, which is the rarer case, right? Hedge pressure doesn't like to break. Markets will typically stay on the same side of hedge pressure that it opened at more often than it doesn't as well. That's also statistical edge. So hedge pressure breaks are very uncommon, and we separate out weekly and monthly options to create hedge pressure and monthly hedge pressure. We separate them out to show 2 different windows of time. This is the weeklies, and the majority, like 90% of the market cap of those weeklies is in like 0 and next day options. Monthly hedge pressure are your big firms and funds hedging large positions. So we're looking at like the immediate day's pressure and those other weekly options to go with it, balance for today, and then the monthly pressure together. When hedge pressure breaks, it can create a lot of volatility in a move. What we found, we call it the atom bomb. Atom bomb. Or if he likes to call it the atom bomb. Which is where you have your monthlies and your weekly's hedge pressure are exactly the same, which you're creating gamma effect, right? Negative gamma flips to positive gamma. It can cause a really nasty squeeze. And if you're squeezing 0 days as well as monthly options at the same time, that effect is amplified. You not only have market makers today trying to balance the books for these options expiring today, you have call and put sellers trying to offset a very large position that's being hedged with those monthly options. So you get a lot of pressure off of that. So what you do is you search for hedge pressure equals MHP when they're alike. How many conditions we have? 88 of those. I'm looking at the number right here, 88 tickers. And then you can just start to filter by the breakup case, MHP breakup, or MHP breakdown. HP breakdown gives you the same thing because they're equal. So in the MHP breakup case, you click that, and now you have the case where they're both equal and you've broken through one of them. You follow so far? And this is your runner setting. If you have a bullish greater market is bullish like we showed earlier in the stream, then I'm going to look for some bull breakup cases. I'm not going to look for bear cases to go with it. So you just pick any one of them and they're your runners. When you break through that monthly hedge pressure and hedge pressure right here, the move is so strong almost the majority of the time, vast majority of the time. The volatility dries up, especially in the upside breaks. The volatility dries up and the stock just moves. And it closes at a high. I'm just pulling up a random effect of them. CLH, ONON, AI, etc., etc., etc. Some of them will not be big giant runners like this one. Example, it failed and didn't really go too far, even though it opened here and closed here, it ran a little bit. So not all of them are going to be like big 10, 20, 30% moves, but you will find that this effect doesn't even need a catalyst to do it. It moves on its own accord. As an example, IBM just broke through at the end of the day. It's probably going to close higher. It starts to create its own hedging effect, especially when it closes late at the day. Look, even here, it's breaking the higher highs. Because there's shorts getting squeezed so hard. And when you break through the hedge pressure, you see these giant volume spikes right here. This is proof that it's really, really telling you what we say it's doing. This is your gamma flip from negative to positive that creates that J-shaped curved move, right? The huge volume as shorts get squeezed. That's exactly what it's showing you. So if you're looking for those like penny stock breakouts or whatever where shorts are getting squeezed, is exactly how you find them. There's penny stock right here. Boom. Like that. This stock here. Does this make sense? Now, of course, a lot of things ran today. We have 20 of these cases. And of the ones I've showed you so far, I've gone through 10 of the list. Only one of them just didn't like rally. Like one of them kind of just, I mean, it rallied, it traded higher, but it just kind of barely went higher. You follow? So when you break through it, it just runs really, especially if you have an illiquidity pocket to go with it. One last layer is an illiquidity pocket. When you have bull zone, bear zone spreads like this, bull zone and bear zone tends to like congeal towards the middle. It likes to hover in the middle. Illiquidity pockets tend to move very rapidly across the zone. When bear zone is above bull zone, it's an illiquidity pocket. We've got illiquidity, where the market is simultaneously bearish and bullish at the same time. Here, it's neither bearish nor bullish. You're below the bulls and above the bears. Here, nobody's winning. Here, both sides are winning. And markets rapidly move through illiquidity pockets. That's in one of the cheat sheets. This one right here hates the middle, moves very quickly. If you want to amplify the atom bomb, you add illiquidity pocket to go with it. And when you have that breach to an illiquidity pocket, it will run very quick from one side to the other, and it will avoid the middle. It will like repel the middle. The middle is the worst place for market makers, because imagine this is where all the people are short, and this is where all the people are long, and in the middle is where the shorts are all winning the most and the longs are all winning the most when you add them all up. So in the middle is the maximum winning point of all traders against the house, the maximum loss point of the house itself. The house will do everything it can to push price away from that middle in an IP. Does this make sense? All your shorts are in the money and winning. All your longs are in the money and winning. In this particular space, you have the least amount of losing traders. So an IP will start to pick up momentum and volatility and start to move rapidly. This is more likely to move there than it is to move there. So IPs are very rapid. When you already add the gamma squeeze to it, it typically runs from one side to the other. So my big breakout case, if you really want to look at all of them, is this right here. And there are 7 in this case. And these guys just run quick. You don't always find any. So you don't always find some. But when you do, they're great. Here's an example. See how it just runs. It does not want to stay around in the middle at all, in between bull and bear zone. It pushes to one side or the other. It's a very good indicator. Here's the best example of it. We just showed this one earlier. And when it returns, it doesn't just hang in here. It falls back to the bull zone as well. This is the tried and true textbook IP. You see how it doesn't hug the middle? J Sasha? GH? So when you get that break in an IP, that's a great signal. Like example is, if you were to long on this one, if you were to long on this break right here, and then it goes through here, your body goes, oh yeah, I'm looking for that with the stop right here. And I let it ride. Yeah, it'd be fun to play with. And the trick to like runners is, again, any kind of stock on a scanner, you should always diversify. This is a technical play. Markets are moving on hedging alone, right? Catching traders off guard. And clearly in this case, you create all that short gamma flips positive. It forces a bunch of longing. And then as the market breaks into here, do you see all this crazy amount of volume spikage that kind of comes through here? Because what you're doing is you're surprising a bunch of traders who are short to have to flip long, or a bunch of call sellers that have to chase the long because the call just went in the money. Typically, volume is high at the start of the day and like decays towards the end of the day and then picks back up. In this particular case, volume amplified in the middle of the day. You had this weird spike in the middle like that. Unusual, right? Well, as volume is supposed to be decaying from here, it starts to amplify the moment the atom bomb takes off, right? Volume starts to grow. And that's typically is what's happening is your traders are getting squeezed, right? You're catching people off guard and forcing them to play. And there's not a lot of volume in the stock to begin with, but you can easily see that the moment you break through here, the average volume starts to grow and then grow. And even with no volume here, it still breaks the highs for the day on no volume. It's funny that you see this, right? Even right here, volume is in decline and market still goes higher because the computers, the house is programmed to raise the bid because the house is the one that has the risk in the middle. These market makers will raise the bid very rapidly and it'll move on no volume. Pretty cool, right? So what's neat to see is that the break, hold on one second. Sorry about that, a phone call. But so the neat thing about illiquidity pockets is that it doesn't even take volume to push it higher. The volume, while it did come in, volume is clearly in decay as its bid is being moved to higher highs. Even here, this is very little volume and it still pushes higher. And then, of course, when you get in that bear territory right up here, there's a lot of activity that's taking place because the illiquidity pocket. Now these are all of your shorts that are getting squeezed right here. A ton of people short, forced to cover and get out of the way. And it's really strong, right? I love these things. Yo, what up, Chase? Just joined. What's the atom bomb? Okay. This is named after Adam Cash. You guys know Adam? Hold on. One of my vendors is asking for a burning kit. Hang tight. Design package? Logo package? Is that it? Let me give them a logo kit here really quick. Let me zip this file. Logo package. The marketplace is getting a lot of traction. Can I tell you something crazy? With the marketplace, we sit down with meetings with people to show them what we have at the marketplace. I'm not kidding you. We have 100% conversion. There has been 0 vendors that we have sat down with who have said no to our marketplace. Adam and I are batting 1,000 right now. So if you have a friend, the services we provide, there's so many things for trading vendors. It's incredible that how responsive everybody has been, even at the stage of the game. So if you have friends that are selling anything or have Discord rooms or free rooms, free products, doesn't matter what it is. We'd love to showcase what it is they do on the marketplace. You really want to create a beautiful thing here. Hold on, let me get my friends in here really quick. Okay. But yeah, so the atom bomb is when monthly and weekly options line up and you get a hedge pressure break and you're in an illiquidity pocket is my spin on the atom bomb. It's the atom bomb. It's the hydrogen bomb at this point. So that's it. I add an illiquidity pocket to make it move even quicker. What is the yellow line in the resilience chart, Andres? Yeah, let me go over that really quick. So on resilience itself, let's load up SPY right here. All right, so it's going to take you a little bit of understanding of what resilience actually does. And very quickly, the resilience indicator just comes with 2 packed in 1. There's a white and a yellow number. The white goes with this right here. The yellow goes with this right here. So the white line here is talking about the behavior inside of this box. Call this res. The yellow is the behavior around that line. So the idea is that resilience is tracking what the sum of the stocks are doing. If the sum of the stocks are breaking through hedge pressure monthly hedge pressure is going to respond. The idea that the overwhelming majority of stocks are above their monthly hedge pressure rather than below is used as a tiebreaker. This is market cap weighted, by the way. The majority of the market cap of the stocks are above their own respective hedge pressure. So like if you had a bunch of stocks like Apple and Google and Meta, and Apple's trading here and Google's trading here and Meta's trading down here, and we're going to market cap it up, the sum of these things, for the most part, is likely going to be positive. 2 of them above and 1 of them below. So monthly resilience will be slightly above 0. This is the not telling you the math of what goes into calculating this, but in a way, it's like a seesaw. The 0 point is the middle of the seesaw. If the majority of the market cap is fluxing above hedge pressure or breaking through it, it's going to tilt this one way. So the yellow line is a yellow tiebreaker at the yellow line. So when you're trading near this yellow line will give me the answer. If market's falling through here and touches this yellow line, and there's a, okay, maybe there's a pivot off of there or something, do I bet on it breaking or bet on it holding? And this is the tiebreaker that's telling me I'm going to bet on it holding. Chase, it's MHP break up or down. They work in both ways. You can find upside runners, downside runners. Okay. And then just lastly, resilience is the flux from here to here, just in the box by itself. If resilience is positive, then we expect the market to push from here to here. And if you're outside the box, from here onward. So this is major support on the index. So like this morning, res was negative and it flipped positive right about here. It's NASDAQ. But in either case, I have SPY and NASDAQ, but SPY resilience went positive right there. So if SPY was breaking like this, the negative res was pushing towards this side of the box. The positive res was supporting on that side of the box. So anytime you break or run in one direction, it's going to show you how the index is tracking the stocks inside of it. There's a really good flux indicator from here pretty much onward minus this spot and this spot. It was just showing that you're going to have overwhelming support right there. That's all that the white number does. So it's a tiebreaker. So the white number is a tiebreaker at this halfway point. But in the box, the yellow is the tiebreaker at that point. So if you were to fall and get to here, the white number is the tiebreaker to tell you which direction you play it. If the majority of stocks are doing that, then the index is more likely to do that as well. Does that make sense? Okay, and then we go back to talking about atom bomb. So sometimes the stocks are going to flip-flop and be crazy. One can see that resilience was negative up until about right here. About right there. And we had an irrational market. So sometimes the index will sell off before the stocks are doing, and the index will rally before the stocks are moving. And that's just something that happens because the index can trade on its own. So today, you can see that there was really strong selling pressure for most of the day. That's because your res was negative. I think a lot of us were taking shorts at the start of the day. I know I was. And I shorted here and got squeezed because the index moved before resilience caught up. And that happens occasionally. When these lights are red, it's more likely that that happens. When these lights are green and yellow, it almost never happens. The resilience will lead the pack. Is a leading indicator. So right about here, it's not negative anymore, and it's mostly holding positive. So when you're outside of the box is the new support. When you open, and now you're supporting at the open and trading higher, if res is positive, then it almost never sells off for the day. It just keeps going. Okay. So they're a tiebreaker. And you never really trade near monthly hedge pressure until it's closer to the end of the month. Monthly hedge pressure, like if I were to draw a graph, like number of days out, days from now, 30 days out. And if the price of the stock was just consistent over those 30 days at the same price, you would see monthly hedge pressure start to move very rapidly close to price. So in the last week or so, unless there's a market reversal or a condition that changes everybody's mind in the market flip-flopping, monthly hedge pressure stays really far away from the stock. And in a bear market, it's the same thing. You'll be above, and then monthly hedge pressure each day will get closer to the price. So around the third Friday of the month, which is monthly expiration, that week, like Wednesday, Thursday, Friday, typically is when you're trading with monthly hedge pressure nearby, and this is very important. Most other days, you're far enough away from it where it just has like a minuscule effect and it's not really actionable. So the yellow line doesn't really come into play unless you're actually touching the yellow monthly hedge. It's just your tiebreaker when you get there. And we're far enough away. We're not even close to the third Friday of the month. We've got 2.5 more weeks. So we're not going to be close to it yet. Somebody in chat is saying, look at Goog. What you doing, Goog? Google? What do you say? Oh. So the atom bomb is for hedge pressure breaks. But basically what the going theory is that when the hedge pressures are on top of each other, it's double strong. Double pressure, double power, double fun. There is no scanner for monthly maps right now, but there should be. That's a beautiful idea. We're going to be staffing up very shortly for some of these bigger projects we're working on. We can free up some of our marketplace staff to get back to making cool stuff for the platform. Ooh, yeah. Okay. So here, Goog atom bomb at 175. Oh yeah, 100%. So it acts as really good support as well in your liquidity maps when they're on top of each other. It's also like a double strong support. Very much so. And the way what hedge pressure actually is doing is a really cool exploit. Like I always tell people hedge pressure, like what is hedge pressure, right? And how is it derived? We take options data. It's only looking at options data. Hedge pressure knows nothing about the price. It's 100% derived from options. We take this big fat options data feed that has all kind of options at price, end time to expiration. Right? All options at all times and all prices. SPY 400 for next month, SPY 200 for this month, SPY 350 for tomorrow, all of them. The whole landscape of options for every single stock. Okay. And what we do is we look at the entire order flow, all the options trades, which is all the options that exist at every expiration, every time. And from that, our algorithm plucks out what it believes of it. It does huge data infrastructure to do this. Our algorithm plucks out what it believes is an option that's bought by a market maker. Somebody who's designed to have a trade that's risk-free. A market maker is only providing liquidity to the market, so they're not trying to take a long or short position. If they get into a long or get into a short, they're going to hedge it with an option or something on the other side. We look for those kind of tandem trades, and we only pluck out the ones that we believe are held by dealers. And this is what our stuff exploits. A dealer is going to assume they're going to hedge their position to zero. Therefore, you can mathematically calculate their exposure and their effect on the market. If I knew that a dealer bought, if I know that you bought 100 calls at the money, okay? So I have two different scenarios. Trader, you. I don't know what the hell you're going to do if those calls go in the money. You can do one of a million things. You can cash out. You can accumulate the shares. You can hold the option for longer. You can do a million things. A trader is going to have profit goals in mind. A market maker in the money is going to immediately hedge it to neutral. If they sold that option to you. So if I sold you 100 calls, you bought them, and those calls go in the money, well, shit, I got a long 10,000 shares because whatever you do, if you assign, then or if you get assigned the position because you exercise, then I got to give you those shares. So if I'm trying to balance my stuff, if I sold you 100 calls, I'm longing 10,000 shares, or I'm longing the amount of shares that match the delta, on a delta hedge. If it's at the money, I'll have 5,000 shares, and then every 10.1 delta, I'll get another 1,000 shares to be delta neutralized. Either way, I'm longing as price is going up. So behavior is predictable because delta hedging is predictable. So what we're doing is we can pluck out the market makers. Their incentive is not one of a million possible options. We're looking for behavior patterns of those types of, and trading patterns of those types of things, where you'll have a long amount of shares and an equivalent options position that was sold against it. You see 1,000 calls sold, 100,000 shares bought, or something like that. You can create that relationship. So dealers are going to try to balance their hand by forcing their risk to zero. And so this is exploiting that particular effect. When you're above here, that balancing act is just more long than short. Like if every trader took their hand off the wheel, the net sum of call sellers and put sellers to those market makers, the dealers of the options, right, selling to the market makers of the stock is what we're looking for. So the way it's really simply put is that if a trader like you or me goes out there and we try to buy a bunch of shares, and on the other side, we had a market maker of stock short those shares. They have a short position. They don't want to be short. They hedge it with 100 calls. So they're now short the market and long the market at the same time. The risk is zero. Y'all follow that? So we try to pluck out those 100 calls from the order flow. Say, aha, he's engaged in a stock trade with you, but he wants to balance it to zero. And then you have the market maker options is the other one that sold those 100 calls. Zones are this guy, market maker, I'm sorry. Edge pressure is that guy. So market maker options, the people that sold the options, that's their risk. The people that bought the options that hedge their position, that's their risk. That's the zones. Y'all follow? So this is the relationship that our entire system is exploiting. This person's trying to neutralize their risk. This person's trying to neutralize their exposure. And this person's trying to make money long or short the market. Both of these people get paid money to trade. Whether they win or lose, every trade they make a few pennies on the dollar. So their goal is to trade as much and often as possible and immediately neutralize it, because they get free money to do that. And so that neutralization effect is what we're exploiting here. The options that are sold, the options that are bought by the dealer of the stock, this is showing you that the people that are long the stock, there's more dealer risk in the money than there is out of the money in general on call side. So if the dealer is delta hedged, if you're trading in a bull zone, they're forced to long more to neutralize that position, that Apple position as an example. If they're down 10,000 shares and they're longing 100 calls, they're fully hedged. What if they're only longing calls at the rate of delta? And if at the money right there, delta was half, they only had 5,000. Price is up a little bit more, well, they got to long some more. Price goes up a little more, they got to long some more. They have to keep longing calls to match the delta, which forces the call seller to long the shares. Just market making 101. And so that's why bull zones are so strong, because it circles back around. As bulls are in the money, then the options dealer that sold the calls to the market maker of the stock is the one that has to long in the direction of the rally. They're the one to propagate the rally even further, because they have to chase the long, because calls they sold are now in the money. They have to be long or else they have exposure to the market. They've sold calls while it's rallying. You don't want to do that. So the relationship between market maker and market maker, the long and short of those dealer options we find, is balanced here. The market maker gamma is negative and positive there. This is the balancing act. So hedge pressure is a tipping point where gamma is the acceleration rate of the change in price of the underlying versus change in value of the option. It's the first derivative of delta, which is the first derivative of the change in price or the change in price of the option. So gamma is a fancy word for acceleration. Delta is velocity, if you remember your basic physics. And price is position. So gamma is del squared price over of del price underlying option squared. Partial differential. Price of the option. The rate of that alone is delta. How fast the option moves relative to the underlying. So gamma is an accelerating factor that when you're basically going from decelerating to accelerating. So it creates very rapid onset of velocity. And what we found is that we separate out the monthly and weeklies for a whole different reason, because monthlies tend to be more behaviorally like in the range of trading closer to monthly expiration. The weeklies are more actionable day to day. That's why we separate them. And so the weekly being here and the monthly being here, when that starts accelerating this way, you just basically see that the market starts to like curve away from it. It doesn't just like rally and slow down. It actually starts to pick up steam. And you can see it right here. There's a little bit of curvature to this. If you zoom in just enough, it's like a self-propagating thing. You kind of see that it kind of picks up like a second slope right here and starts to curve a little faster. Right? It's actually got a little bit of curve to it. That's that hedging effect. That's exactly what it does. Hedging creates more hedging, creates more hedging. It's like a snowball effect on itself. A little lesson for y'all today. So any of these like atom bomb type things, you will notice that when they break, it's curving before it slows down. So if you're like to zoom in just enough on these bottoms here, you know, see how it's like slightly, it's slightly curved like that. Slightly. That's the onset of the hedging. And then the break, obviously, there's the volume that creates the break from the gamma shift from negative to positive. There's a volume spike right here that I'm circling. I can see that. It's a little small. Once you interact and break through hedge pressure, it creates volume. And then once you start squeezing out shorts, well, there's your shorts that are getting squeezed. There's negative gamma switches to positive, then you go. Yeah, as John said, the rate of change of delta is gamma, and delta is the rate of change of the price differentials. So the neat thing about it is that when you squeeze, it creates rapid curvature. That's why it's such a strong indication. This one is interesting to see because it shows like kind of an inflection point right here. Like you can see that while it burped really quickly, as it's consolidating, it starts to pick up momentum here. There's an inflection point. Right, concavity kind of, it speeds up. It's neat to see that speeding up, and that speeding up is usually accompanied by asymmetric volume patterns like this, choppy volume that you see in there. Because what's happening is that shorts are getting rapidly squeezed out. And then here's more curvature again, and that same effect. Choppy asymmetric volume. Pretty neat, I know. Thank you. Same thing here. Can y'all start to see that like in these atom bombs, it's not just a break, but you're seeing the effect of the hedging as it's speeding up. Does everybody agree that you see curvature? It's a self-induced rally. It's not rallying just on news or effect. It's rallying because every time delta goes up on any option, like say a call that goes in the money, every time a call delta goes up 10, then some call seller is longing 10 shares into the green candle. They're longing on top of the green candle because they have to stay neutral. So when they long, it pushes up a little even further, which pushes the delta up, which forces someone else to long, which pushes the delta up, which forces someone else to long. And then once you exhaust everyone's risk and they're all neutral, then the curvature starts to stop and then it starts to kind of hang tight. But typically delta squeezes like this almost never do that. So rule of thumb, when you start to see the market curve up like this and consolidate, your brain doesn't go, oh, let me short this in the close. The market has found balance at the high. The whole deal of this curvature going up and moving higher has to do with the balancing act of dealers. It's balanced up here. It's not high that's got to fall. A market that does this, like rallies on news and does this and kind of like slows down, like it moves and slows down, often can have the ones that like sell off towards the end of the day. But markets that move like this either do that and crash out, or they stay high. They don't hang around and then slowly start to decay. This is almost never do you see that. Short squeezes tend to amplify and stay squeezes until the expiration of that option. As I'm saying that, this ADI stock is breaking into new highs. It is balanced up here. It's very unlikely for it to close below there. And it's like normal stuff. Literally the most valuable market education you can get, and it's free. Oh, I love you, man. Thank you. You're the best. Okay, so questions about that? All it is exploiting, it's like isolating where gamma can be predicted and squeeze. Like I can't predict what you're going to do for options you sold because you're just a retail trader. You have your own goals. But I know that a dealer is going to be hedging to neutral. So we make assumptions on that, and that's what we calculate. We have a whole army of computers pulling this options data to calculate it on the back end and broadcast our indicators for it. So that's why this is so strong, is because this blue is the weeklies, and typically mostly 0 days are tied up into there, or next day expiration or next week expiration. And then here, the monthlies are here. When you got both lining up, the effect is much stronger. As I say that, that stock is breaking the highs. So it's one of our favorite setups to look in the options. Look in the scanner for. And you don't have to have the illiquidity pocket. That just is an amplification of that process. But just in general, there's so many stocks under that condition. Let's see if there's any breakdown cases. Let me look at that. It's a great idea. And the scanner you guys can go pick up if you want to go get that. It's on the website. MHP breakdown. Tesla. What did Tesla do today? Oh, okay, so here's an example. And so, like I said, in a greater bull market, the short trade is very short-lived, but you can see that how rapidly Tesla moved. And it triggered the atom bomb. Now, what we don't do is we don't jump in and just chase a red candle on a short. It's a whole different story, especially this close to open. But one would see that if I were long right here, I would get the fuck out of the way because we open above and smash below. I'd sort of walk out of the way. And then as you see, it just sustains this like downward pressure. It's trying to sell off. Now, once the entire stock market started rallying, it dragged Tesla along with it. All right. It is practically untradeable, I would say, at this point, because it happens so fast at the start of the day. If you were to short to some gap fill or some pivot and took a short and got out of the way, I would do that. Normally, in greater bull markets, I don't short anything usually unless I find a good reason to. Tesla would have been a great short from here to maybe there, and I would have taken profit and walked away if I found some exit target to trade off against. But once it broke back to the upside, you can see that it's probably starting to speed up. Again, just like all the other things. We'll see. The rest of the market's starting to trade higher. Yeah, so like Tesla is wanting to trade lower, the rest of the market's speeding up. It's like preventing it from selling off. So interestingly enough, Tesla broke to the downside and was very rapid. One of the few ones that did do that today. Bolero, same story, right? You can easily see that speed picking up like that. There's not that many cases of that today, but there's 2 of them. Yeah, I like the idea of doing these afternoon sessions, you guys. This is a pretty lovely setup. So you have any questions for me? You're late. What did you miss? Everything. Try not to do afternoon stream. We'll start to build up this time slot. Don't forget to check out, there's the extended trial. If you haven't seen the platform, go to the website. It's $35 for the indicators for just a month. Check it out. And I don't normally trade towards the end of the day, especially in environments like this. There's really not much you can take off of it. Just kind of picking up pennies right now. Not many smart people trade in the last hour of the day. That's typically where your big firms and funds are pushing their final positions into the market, or hedging their big positions, or shifting their risk, or balancing out for the next day. So this is like, people call it power hour or whatever, is for retail traders the most dangerous place to do anything. I would say that, like, this, we teach people after, nothing good happens after 2 o'clock. You're just gambling off of noise at that point. The market's very unpredictable there. The proof is in the pudding. You can see right here, you don't have any, you have asymmetric volume going on, and volume is starting to pick up going into close. It always happens like that. And then of course you have these big volume spikes in here. And the market's not likely to do much. Whatever it ends up doing, it's likely to kind of stick to where we are. So, and typically, like, the end of the day is just kind of no man's land. There's really no good trading. And I always tell people, is like, if you ever wanted to do one thing to change your habits, you want to do something that I promise you again. I know it's not necessarily legal to promise gains to anybody, so I can't give you any gains promise. But I can promise you something. I will give you some medical advice, even though I'm not a doctor, so don't listen to medical advice. I can keep you from having a headache. If you want to change one thing in your life, don't ever trade after 2 p.m. Eastern. It's a guaranteed way to lower the number of headaches you get trading. 100% accuracy on that comment. If you need one thing you can change tomorrow to make trading just slightly more palatable for you, or more tolerable, or less of a headache, you will realize that trading after 2 p.m. will nuke your win rate. you will be wrong more often than not in those hours of the day than you are right. The market is random after 2 p.m. It's called random rules. Very random. Anything can happen, and you can't predict how firms are going to close out their positions or close out their books that day. Just stay away. Everything's predictable at the first half of the day more often than the last half of the day. AI, an interesting one. It's Nara. Oh, what up, Nara? What up? Crazy short interest in names. It could be nice. Yeah, right? What's up, dude? For sure. This is my first time streaming the afternoon. We don't normally do afternoon sessions, so we don't normally do this slot. I'm going to try to grow it, though. We should have a big stream in the mornings. So this is just a whole new thing I'm trying. HP breakup, yeah. Had an atom bomb today. Oh, yeah. That is my biggest tip to people is avoid the last 2 hours of the day. You're just gambling. And there's better things you can do with your time and money. And here's that randomness I talk about, right? You see how the market's just kind of moving all over the place. You never want to try to make heads or tails out of this closing hour of the day. At 350 every day, you have the submission of MOC orders by large institutions to the dealers, and that's really what causes that end of the day shifting of positions. They see where the sentiment is based on all those closing orders, and they're trying to move the bid to match where they think the market's going to be the most liquid at close. And so you tend to get a little spark on in the last 10 minutes as those orders are submitted and the deadline hits, and then the price just shifts to the next liquid spot. This weekend, we're going to try to move everybody in-house over to the marketplace. And you should wake up with no change, but you should have marketplace account available to you. It should be at that time your login and your current login and password at Rocket Security. We're going to move you over. And you can start managing and accessing stuff over there. We're going to move the courses and all the course material over into the course packages after that. That's basically it. A movement in the close. This is why I tell people, end of the day, don't even trade this. Like, let it do its thing. All right, love y'all. I'm gonna get out of here. See y'all bright and early in the morning. We're starting this afternoon session, so tell all your friends. Not really a big turnout because we don't normally have this session ever. So, but I expect to grow it. I'll be consistent with it. I need to start streaming the afternoon again, like I used to. Get a little bit more time now. Developments reaching steady state on the marketplace stuff. Things there are so nice. Like, just like marketplace site. I don't want y'all going there yet, so I'm not showing you where to go, but don't go there yet. The vendor page where we can sell all our stuff, Discord indicators. You can sell all the different pieces that you want, make them all in our scripting language. Marketplace allows you to search for different products, different Discords, different things. Where all kind of different, you might see some familiar faces there. Pretty nice. So you'll be able to log in, get your own stuff there, and it's gonna be great when we launch. Okay, love y'all. See you later. I need something that's, there we go. Plus, I was just testing out the new look of the stream as well. I'm trying to put the trader bait on there so you can see my trading. Put that back on the screen. All right, love y'all. See you later.